Hi everyone, this is our FSA Project, and in this project we'll be looking at two local coffee chains in Taiwan. We will be comparing Louisa versus Kama. In the first few slides, we kind of talk about why we chose this industry and why we picked Louisa and Kama. And if you're interested, you can pause and take a look at it.
Louisa Coffee, a Taiwanese coffee house chain founded in 2006, had the most locations in Taiwan by 2019. Known for its quality and craftsmanship, the company has expanded to overseas markets like Thailand and Singapore. Recently, it has been diversifying into other industries, including integrating with fitness centers. Let's use SWOT to analyze Louisa and Kama coffee. The strengths of Louisa coffee include strong brand recognition, diverse product range, strategic locations, innovative marketing, modern and cozy atmosphere, and high-quality beans. Weaknesses are dependence on a local market, competition with local and international brands, and quality control when expanding the number of stores. Opportunities are international expansion, product innovation, and digital transformation. Threats are economic uncertainty, customers' preference, and supply chain disruptions.
Kama Cafe is a Taiwan-based coffee house chain founded in 2006. It has since grown to over 200 locations across Taiwan, and the company has been profitable for a few years, and it is looking to expand both domestically and internationally. So now we can take a look at Kama's SWOT analysis. First of all, they have very strong brand recognition. Also, they have very high reputation for their high quality coffee and also experienced and skilled baristas. And also, they are very transparent and open in making their coffee. So those are some of their strengths. And moving on to their weaknesses. In comparison to Louisa, they have relatively higher prices, and also they have limited number of stores. Moving on to some opportunities, because there is a growing demand for specialty coffee trend in Taiwan, so this is a good chance for Kama to show what they have. Also, there is an increasing popularity of home brewing, which is also a good thing for Kama because they emphasize on selling their high-quality beans. Last but not least, threats, because there is quite an intense competition from other coffee chains in Taiwan. We have so many choices to choose from when it comes to coffee, so this is one of the greatest threats that Kama is facing.
Let's see the balance sheet. It reveals that Louisa and Kama Coffee have been significant increases in investment property and long-term loans, reflecting business expansion. This indicates that both companies adjust their operational strategies as they pursue international development. The comprehensive income statement of Louisa shows that operating revenue has increased annually. However, due to rising marketing expenses, operating profit has experienced significant fluctuations. From Kama's income statement, it's evident that operating revenue has declined after 2021, possibly due to the impact of pandemic. Additionally, the increase in sales and administrative expenses has resulted in fluctuations in net profit. For Louisa, although its current ratio is below 100%, the liquidity of its current assets is high, and for Kama, its current ratio has been quite stable every year. For quick ratio, Louisa experienced some fluctuation in liquidity from 2020 to 2023, while Kama maintained a relatively stable and healthy liquidity position over the same period. to asset ratio increased over the years and showed a higher level of leverage, while Comma's ratio decreased initially before stabilizing, suggesting a comparatively lower level of leverage. Overall, changes in the debt to asset ratio reflect shifts in a company's capital structure, financial decisions, and broader economic conditions. Luisa's debt-to-equity ratio has been on the rise and indicated a higher level of debt relative to equity over time, while Kama's ratio decreased initially before stabilizing. It suggested a comparatively lower reliance on debt financing. Overall, changes in the debt-to-equity ratio reflect a combination of strategic, financial, and market factors that influence companies' financing decisions over time.
Next, we're going to talk about the liquidity and efficiency. From the graph, we can observe that both Common and Luisa experienced a decline in receivables turnover ratio in 2021. Overall, Common's collection speed was faster than Luisa's. Next, the main reason for the significant decline in inventory turnover for both companies in 2021 was primarily due to the continued expansion of stores, which led to an increase in accounts receivable at the end of the period. Como's inventory turnover ratio was relatively lower than Luisa's, but its fluctuation was stable, indicating that the pandemic did not significantly impact its inventory management. This stability is also related to its active cooperation with delivery platforms. Overall, it's still lower than Luisa. In 2021, Luisa's inventory turnover ratio rapidly declined due to its continued store expansion, which led to an increase in year-end inventory. It's the same reason contributing to the decline in receivables turnover ratio. Luisa's total asset turnover ratio decreased due to a cash capital increase, which resulted in an increase in cash on hand. Coma's total asset turnover ratio remained at a consistent level but was still lower than Luisa's. When we're talking about profitability, we can first take a look at the graph and we can observe that the confirmed cases increase rapidly started from April in 2022. Here's a graph of Coma's and Luisa's ROA and ROE. First, we're going to talk about Coma's increase in 2021. In the fiscal year of 2021, the significant increase in Coma's ROA and ROE was due to the rise in net income after taxes. It is owing to the expansion of operational scale resulting in higher profits from merchandise sales, brand revenue, and restaurant income compared to the previous year. Then, the Coma's decrease in 2022. In 2022, the reason for the decrease in company's ROA and ROE was due to the rise in raw material costs, increased personnel expenses, and depreciation from new store openings at the end of the year, which led to a reduction in net income after taxes. Last but not least, the impact of COVID on both companies. In 2021, Luisa's ROA and ROE declined due to the impact of the COVID-19 pandemic, which caused a 13% drop in revenue. However, Coma grew by 38.8% against the trend, owing to its long-established and well-developed takeout and delivery models. Additionally, Coma actively expanded into various channels such as e-commerce and subscription services earlier than Luisa's. Coma Company's gross profit margin has remained steady at around 44% over the past 4 years, showing little variation. However, the operating profit margin, similar to ROA and ROE, saw a significant increase in 2021 and then a sharp decline in 2022. Since operating profit equals gross profit minus operating expenses, and the gross profit margin has shown only slight changes while the operating profit margin has fluctuated significantly. It can be inferred that the changes in operating expenses are the likely cause. Indeed, operating expenses were 31.12 in 2021 and rose to 37.14 in 2022, confirming the earlier statement. Louisa's EPS temporarily declined to 4.4 in 2021 but steadily rose back to its original level after the pandemic recovery. Although Comma's EPS grew against the trend to 3.74 during the pandemic, its EPS growth after the recovery was not as significant as Louisa's. Louisa's EPS has consistently been higher than Comma's in every period.
Now let's take a look at the growth rate analysis. So from the revenue growth rate, we can see that in 2021, Comma was actually at its best during the beginning of the pandemic. But as we can see from the revenue growth rate and the gross margin growth rate, we can see that Louisa has a more stable growth. Now we can look at some analysis we made by looking at the cash flow. First of all, we can look at the cash flow to net income ratio. And from this chart, we can see that in the recent 3 years, Comma actually did better than Louisa. And we assume that this is because Louisa has been more actively trying to expand their business. And because they spend so much money on renting a place to open up a store and buying inventory or assets, so their net income ratio turns out to be lower than Comma. Now, if we take a look at the cash flow adequacy ratio, we can see that in 2020 and 2021, Louisa has a pretty steady ratio. But in 2022, we see a significant drop, and our solution is that it might be because they want to invest in some services that would get them through the lockdown. And at last, let's take a look at the CFO, CFI, and CFF. Something that caught our attention was actually the CFF numbers. And we can see that both Comma and Louisa went from negative to positive during 2022. And a positive number for cash flow from financing activities means that more money is probably flowing into the company than flowing out, which probably also means that they are increasing their company's assets. And we guess that this is because they are both trying to expand their businesses and opening up more stores.
Louisa's membership basis is bigger than Comma, and its membership contribution to overall revenue is higher than Comma, indicating that its customer retention is higher.
So just to wrap it up, from this FSA project, we can see that Louisa demonstrates a consistent and strong growth trend across revenue, gross profit, and EPS. And also these data indicate that Louisa is improving its overall profitability and financial health more effectively than Comma. So overall, Louisa appears to be a more stable and upward trajectory compared to Comma. But we love both these local coffee chains the same, and we hope that they both keep up the good work. So thank you for your time, and this is the end of our FSA project. Bye.